Hi everyone, this is Dr. Pradeep Reddy, Sage University Bhopal, wants to bring you about the banking sector reforms in Indian economy. In this video, I would like to present the pre-era and the post-era of the banking sector reforms. There are evidence regarding the existence of money lending opportunities in India is found in the literature of the Vedic times, that is 2000 to 1400 BC. And the literature of the Buddhist period is also an example, like the Jatakas and the recent archaeological discoveries supply evidence to the existence of bankers. It is not new. In the 2000 and 1400 BC itself, we have recognized the terms of existence of bankers. And before independence, modern banking in India started way back to 1786 with the establishment of the General Bank of India. And in 1806, the East India Company established the first presidency bank in Kolkata. And two more banks were established in 1840 and 1843, named Bank of Bombay and Bank of Madras. And the Reserve Bank of India, RBI, came into formation on April 1st, 1935, with the enactment and 50 of the Reserve Bank of India Act 1934. And the objective of establishing the Reserve Bank, as stated in the preamble to the RBI Act, was to regulate the issue of banknotes and the keeping of reserves with a view of securing monetary stability in India. And that is the post-independence. Let us see what is it. Even after independence, the banks were mainly urban-oriented and were beyond the reach of the rural population. A large section of the rural population still had to look upon the money lenders as their resort for credit, because still banking was not developed in India and people were not habituated to use the services of the banking. So that's why the government decided to nationalize all the major banks in India, and the first nationalization took place in 1969 and the second one in 1985. In 1969, 14 banks were nationalized, and in 1985, 6 banks were nationalized. And the main reason behind the banking system reforms in India is the Indian economy witnessed a series of difficulties like uncertain political situation, persistent fiscal imbalance, and the double-digit inflation, the balance of payments crisis, and others. The fiscal situation, which was under strain throughout the 1980s, reached a critical situation in 1991, and the external payment crisis and the high rate of inflation both reached their peak level in the middle of 1991. And the growth of real GDP declared partly because of lower industrial growth and partly because of the slowdown in agriculture. And the industries were affected because of lower government investment, non-availability of inputs due to import squeeze. Recession prevailed in the industrial economy due to the collapse of demand in the markets of Kuwait and Iraq in the wake of Gulf crisis and the collapse of the erstwhile Soviet Union. And in over 5 decades since independence, the banking system in India has passed through 5 distinct phases. The first one is evolutionary phase, that is prior to 1950. It is called as evolutionary phase. And from 1950 to 68, it is called as foundation phase. And from 1968 to 84, it is called as expansion phase. And from 1984 to 1990, it is called as consolidation phase. And since 1990, it is called as a reformatory phase. Let us see the names once again. Prior to 1950, it is called as evolutionary phase. 1950 to 1968 as foundation phase. And 1968 to 1984 as expansion phase. And 1984 to 1990 as consolidation phase. And since 1990, it is called as reformatory phase. And prior to the reforms, the Indian banking sector was characterized by administrative interest rate structures, quantitative restrictions on the credit flows, high reserve requirements, and imposition of stringent regulations by RBI, and low productivity and efficiency in public sector banks, and deteriorating portfolio quality and increasing NPAs, and inferior work technology and poor quality of customer service and inability to face competition. So these are the basic reasons why reforms have came in. That is due to lack of administration, lack of quantitative restrictions, and high reserve restrictions and stringent regulations by RBI, deteriorating portfolio qualities, increasing NPAs, inferior work technology, and poor quality of customer service and inability to face competitions are the reasons why banking reforms have characterized. And the main basic objectives of banking sector reforms in India are with the objective to improve the overall performance of the Indian banking system, and reforms were aimed at bringing a transformation change in the structure, efficiency, and stability of the banking system, and also integration with the international markets, and to make Indian banks internationally competition, and to encourage them to play an effective role in accelerating the progress of growth. And the reforms in the banking sector in India intended to enhance the stability and efficiency of banks, and to remove the operational rigidities in the credit delivery system to ensure allocation efficiency and achievement of social objectives. And these are the objectives. And also two more are there: to place the Indian banking system on the international standards in respect of capital adequacy and other prudential norms, and the strengthening measures aimed at reducing the vulnerability of banks in the face of fluctuations in the economic environment. And these included capital adequacy, income recognition, asset classification, provisioning norms, exposure norms, improved level of transparency, and disclosure standards. So these are keeping this view as the objectives of improving Indian banking reforms. The RBI has extended its wings, and in our next video, we will see the two phases reforms of Narasimhan committee, of first committee and the second committee. Thank you, everyone.